to Scorpio Trading. This is the second video of the series, and in this video, we'll be focusing on ranges and the different aspects within ranges which one could use to either design or refine their own systems. And before we continue, there's two special points that I need to make. The first is that uh, the goal of this video is to make people aware of the different aspects within these concepts which you can use. So what we are not doing here is providing the exact way on how they are used. And the reason for that is that depends highly on the other variables you have in your system. So you can't just consider certain variable in isolation and say this is exactly how you should trade it. That doesn't work. So what we're trying to do here is to make you aware. So based on the other variables that you have in your system, you can adapt and collect data on these variables and finally utilize them to have a better system. For example, if we assume somebody has a system which is prioritizing frequency, which means you are going to have lesser variables and a low win rate, then one could use an entry model to act as a filter. So you're going to have a stricter entry model. And what you're trying to do here is to keep some semblance of win rate. So the goal of your entry model in this case is to avoid unnecessary losses. But now if we use that same entry model in another system where the priority is win rate, so it already has a high win rate. So it has a large number of filters and a low frequency. So if you use a stricter entry model in this case, you're going to have an even lesser frequency. So it's the same entry model in two different systems, and they're going to have a different impact in each. One is suitable and the other is not as suitable. And the same thing applies for something like liquidity. So if you consider the size of a specific liquidity pool, if you're going to use engineered liquidity as a further confluence to your entry, then the size of the liquidity pool is not as important as in a scenario where you don't use engineered liquidity. On the other hand, if we consider about size of liquidity or rather location, if the location is further away from the entry point, then maybe the size of the liquidity is going to be more important than if it was located near. So it's again the same concept, but the utilization is different based on some other variables that you have. That's the first point. And the second is wait until this full series is over before you try applying these concepts. And the reason behind this is a lot of these concepts, they work together with the others. So if you're just going to watch this video, get on the charts and try to incorporate something to your system, it might be a waste of time because when the other videos drop, you might have to change them. So it's best if you could wait until the end, learn everything, and then check everything together when you're trying to incorporate this to your systems. So let's get into the meat and butter of this. So this is basically what we are going to talk about in this video. The first thing we have to understand is when we think about ranges, we are not talking about consolidations here, but rather price lag. So we are not talking about what people consider consolidations or ranges, but rather our focus is something like this. So basically, this is what constitutes a range. So first, we have to identify the trade types, and you can define a range as a specific type based on these four factors. It can be either classified based on direction, efficiency, liquidity, or degree. So when consider direction, we are not talking about if it's long or short, but rather if your range is a continuation, so which means it's something like this, or a reversal, which means it's something like this. So this is a continuation leg, and this is going to be a reversal leg. So this is something most people do consider, but what you also have to consider is the probabilities of these types of ranges. So in that case, you can consider two specific scenarios. The one is in isolation. So you're not going to consider anything else. You're just going to consider these ranges in isolation. And you're going to decide if both of these are equal in their probabilities or if there's a difference. And in most cases, if you are considering this in isolation, then a continuation leg is almost always high probability than a reversal leg. But if we consider support for these ranges, so assume a high time frame liquidation or a high time frame range support in this, then there's going to be a difference. And based on the other variables on your system, you are going to have to collect data and identify which of these works better, or if you could trade both, or if you could just focus on one because the other is low probability. That's going to depend on the other variables you have in your system. Then we go to efficiency. And here we'll go much deeper into efficiency when we talk about order flow. That is the fourth video in the series. But for now, what we're going to consider is there's two forms which you could consider. The first is people sometimes use fair value gaps as inefficiencies. And there's some merit to this, but it's not something I personally like because a fair value gap in a high time frame does not always mean there needs to be an inefficiency, but rather a better way, which I think would be better suited for most people, is to consider ranges and see if there's gaps between these ranges. So in this case, this range comes into this range, so it's efficient. But here you have this gap, which means this range right here could be inefficient. So that's one way you could use inefficiencies and efficiencies. And this doesn't mean you can't trade with a fair value gaps or you shouldn't trade with fair value gaps, but rather this depends on the other variables you use, because you could use a fair value gap. And if your other variables support how you trade, then maybe it works. But I think what we just discussed here might be a better option. So when you consider that, let's assume you currently have a system and you want to see how this works. So you could just use your existing data set, basically journal, and go through each of the trades that you've taken and classify them based on if the range that you've taken is efficient or not. And this would give you a good idea if trades taken from efficient ranges versus those taken from an inefficient range has any difference in performance. And most likely you'll find that those taken from an inefficient leg might have lower performance when compared with those taken from an efficient range. And here, liquidity, when we talk about liquidity, one of the things that we have to keep in mind is, like I said previously, these concepts work hand in hand. So you can't just isolate something. So you can also define a range based on where liquidity is located. For example, you can have a range where the liquidity is located internally. And you can also have a range where the liquidity is formed externally. And then there's also the instance where you can have liquidity formed on the RTO leg. So it's not formed in the impulse, but rather on the retracement. So based on where liquidity is formed, you can also define your range and again, use those as data points or rather filters to analyze your data. And then when we talk about decrease of ranges, this is basically related to structure mapping. So how are you going to determine the degree of your ranges? So one of the most common ways people do that is using time frame. So you go to a time frame, which you may consider high time frame. So you eyeball a high and a low. So this is going to be your high time frame. Then you're going to get on a 15-minute or so, and then mark out the lower, the small ranges. But again, an issue with this is time frames don't account for volatility. For example, a 4-hour candle formed in the dead zone, that is between the end of London close and before Asia begins. A candle that forms in between that and a candle that forms, say, during CPI, they're going to look totally different, right? So is that actually a good way of doing this? If not, what is a better way of doing this? And this is a hard question to answer for most people because you can't just say something is wrong and something is right, but rather this again depends on the other variables. But say if you use what we talked about here, then you'd probably need to be stricter on your other variables. But say you have a much more mechanical and a much more logical approach to ranges. So say somebody could consider a valid range to be one that has taken liquidity. So this can be considered a valid range. Or somebody could use mitigations to validate a range. So this could be a valid range. So these, when you consider ranges as these or any other logical approach, then they are not arbitrary like the example we just talked about before using timeframes. So this is also one thing that you have to keep in mind and check within your systems. And also this allows you to mechanize your system. So you can have rules even for ranges, which is something most people don't. And this is also going to improve result. So we talked about range types, and now we are going to talk about context and ranges. So this is pretty self-explanatory. So you have pro-trend, counter-trend as context, and then the impact of opposition. So when you talk about being pro-trend versus counter-trend, I don't think it's exactly suitable just if you think about direction. So assuming you have a 4-hour range, I'm just using the 4-hour just to explain. So assume you have this range here, and let's assume you have POI here, and price comes back here, takes out some liquidity, and then it starts creating some structure and moving up. Now, when you look at this, and let's assume we have some price legs here as well. So when you assume the 4-hour is bullish, you're going to consider bullish as being pro-trend and bearish as being counter-trend, which is fine. But what if you consider something like this? So just because the 4-hour is pro-trend, does that mean every price leg that is formed here is going to hold, especially when you have something of an intermediary range formed here? That's probably not going to be the case. So points like these, they may give you a deeper retracement than otherwise. So in that case, can you just consider PT and CT based on direction alone? No, which means you'd have to consider this leg in price or maybe this leg in price to actually consider where and when price is going to move most likely. And that is where oppositions come into play. And opposition is basically anything, any valid range or liquidity that is opposite to what you're going to trade. So for example, if somebody is going to trade this, then you're going to consider this as an opposition. So this will have some impact on this. And assuming you had some high time frame POI or liquidity here, then if you are trying to trade this, you'd have to consider this. Is this going to hold? Does this have some support of something higher than this? Or is this going to break because this has more influence? So you'd have to consider that as well. So rather than just using pro-trend and counter-trend for your direction or context, you should also use oppositions. And we'll also talk about more of this when we talk about order flow and how you can do this. But for now, you should also use oppositions in addition to identifying pro-trend and counter-trend trades when you trade, because that's going to make a big difference. And then you come to the concept of current ranges. A current range, as the name implies, is basically asking yourself the question of which range is currently valid. So when you look at a chart, you're going to understand that there's going to be a lot of ranges. And the question is, which range is in play at the moment? And here, obviously, it's going to be fractal in nature. But let's say you consider this range right here. So you have to understand, is this currently a valid range? Or is this the valid range? And is this going to be liquidity? That's the question you should answer. And what this allows is, first of all, it allows you to understand whether a certain range is valid. So assume again, you have this range. Now, is this going to be valid? That is the first question. And the second question is, it's going to answer is the range you're looking going to be liquidity? And the third question that you're going to get an answer to is, at which point when a range breaks, is it going to be an actual reversal? So assume you have a large range like this, and you have price doing something like this. Now, if you consider this leg, is this going to mean that minor structure, so assume something like this, is this going to mean that minor structure has broken and these ranges are not going to hold and price is going to come here? Or is this going to mean that this is going to act as liquidity and price is going to do something like this? Now, these are again contextual, depending on what is located to the right and depending on where this liquidity is located, and if this is actually a liquidation or a breakout. These questions need to be answered before you can identify what this is going to do. So again, context matters, but this is something you have to keep in mind, because sometimes people just use a singular breakout structure as a change in direction, but this could also be what we call a fake BOS, which can be used as liquidity to fuel a continuation. So those are the three functions of current ranges. And basically what this allows you to do is identify the range that is in play at a particular point in time. And then the fourth concept, or rather the variable we can look at, is range or POI exhaustion. So when we talk about ranges and liquidity, assume this is a valid liquidity and you have a POI like this, and price liquidates that. So assume we have something like this. So now at this point, there's two things, or rather three things that can happen. The first is you're going to get a continuation which results in a breakout structure. The second is you're just going to pretty much do nothing and break that price line. And the third is you're going to get a reaction, but then eventually break the range. So for each of these, what is the deciding factor? It's going to be the liquidity. Is the liquidity present here enough to fuel a continuation to give us a breakout structure? Or is there almost nothing there that price is just going to go through it? Or is there just enough to give you a small reaction, but not enough to give you a break of structure? So those three scenarios can happen. And how you can use this is usually when you don't use context, because if you use context, then you have much more information regarding if a range is going to result in a breakout structure or not. But assume you don't use context in your system, because nothing in trading is absolute, which means you can have a trading system which doesn't use context, right? So assume something like that. So in that cases, you can use this logic to identify a level where the majority of your trades go. So assume it's maybe 50% of this range. So you can use this either to break even your trades or to remove your limit entries, or even maybe to take out partials or profits, right? So what this does is it can, for one, remove unnecessary losses, and two, give you a better idea of what price is doing so you could take partials. And this is extremely important if you don't use context, because if you don't use context, you don't know if you are trading in the right direction. So in those cases, you can avoid most of your losses if you incorporate this. And then this is again something I don't think a lot of people talk about. LPOL stands for last point of liquidity, and LOFP stands for last order flow point, right? So what these are is something like this. So assume again, you have this range here, and this is going to act as liquidity. Now, the first thing you have to understand is any point of liquidity such as this, it's going to be a range as well, right? Because this is going to be a leg in price. So this is a range. And ranges needn't be classified by the size alone, because assume something like this. You have something like this. Okay. Now, if you assign degrees to these ranges, we are probably going to understand that this and this is going to be the same degree of range, but only this is visible on a given time frame. So the last point of liquidity is basically you're going to draw a line here, and then you're going to have a line drawn here, something like this. So what this is going to do is it's going to understand, it's going to let you know the last point of liquidity in relation to this leg in price. And this is going to act as the real liquidity, even though this is what you see on a specific time frame. So assume price does something like this. So if price does something like this, and you know about this point, then you could probably avoid trading this, because this is likely to be a trap, and then wait until this is taken. So you are getting the actual rate. Now, again, you can't use this in isolation, because what can also happen is this might not be the current range. This might be a current range, and this might act as liquidity. And price could actually give a real move from here as well, right? That is only valid if this acts as a current range. But what if this isn't a current range? Then you're going to use the LPOL as the actual liquidity and wait for something like this, right? And then when you talk about the last order flow point, that's going to be pretty easy, because that's based on the LPOL. So that's basically you are going to identify the last unmitigated structure here. So assume something like this. Now the area from this high to this low is unmitigated, right? Because the last point of liquidity is here, and we haven't tapped it like this. So this is going to be an actual POI. So you could actually wait for price to take this liquidity and tap into this last order flow point before you take the entry. And what you have to understand is all of these concepts we're talking about, you don't need to use all of these. You just need to use some of these based on what you're prioritizing. So assume you're prioritizing your win rate. So then something like order flow points and the last point of liquidity can be used. Or assume you are focusing on frequency, and because of that, you are not using context. So, but just because you're prioritizing frequency does not mean you can just ignore win rate as a whole, right? Because your system still has to be profitable, because it doesn't really matter if you take 100 trades per month and all losses, right? You're not going to earn money. So you have to have a win rate that makes your system profitable. So assume you're focusing on frequency, but at some point you are going to have a considerable level of win rate. So you can use some of these, especially something like this, to get that win rate. And then we are looking at premium and discount. It's a pretty easy concept. And how most people use it is just you use the fib and use the 50% as your filter. But what I experienced from around 6 years of trading now has been that the 50% is mostly used as used to engineer liquidity. So you'd probably get something like this from the 50% rather than the actual move. Now, again, there are instances when the 50% can work. And that's usually when this move right here is created with momentum. So assume you had a high impact news release here. So in that case, yes, something like this can happen. But in most cases, what you'll see is that the 50% is used to create liquidity and price will move further before giving the actual move. So how are you going to use this? So you can use the fib like I've done here, and you could, based on the data that you have on your systems, you could probably use the 25%, 20%, even low or higher. That depends on your data set. But my recommendation is not to use the 50% unless you have a high momentum move here. So rather something small is going to be better. And you also have to understand, right, that the buy low, sell high concept, because the lower you go, the higher the probability is going to be. And it also serves an additional function because the lower you go, the larger your profit is going to be because the longer price has to move. So that's an added benefit. But even more than that, this can be pretty important to avoid smart money traps. So this is about 50%. And then the final one, when we consider ranges, is confirmations. So when you have a specific range, at what point are you going to consider that the range is actually going to give you a move in the intended direction? And most people use, especially in the smart money area, what most people use is a change of character. Now, this is valid, but the issue is people assign time frames for this. So assume someone is going to consider this as a 4 hour and this as 15 minutes. So 4 POI, 15-minute change in character. But again, time frames don't account for volatility. So this could be a 15-minute change of character, but so can this. So this could also be a 15-minute change in character. So when you compare these two, you're going to understand that the degree of confirmation is going to be vastly different, right? Because the larger this is, the more confirmation you're going to have. And the smaller it is, the lesser confirmation you're going to have. Which means a better way to actually confirm trading direction would be to measure either this, or both. So how can you measure this? You can use the fib. So assume, for example, you need the range that is broken to be maybe 20% of this leg, and the resulting move to be 40% of this leg or 50%. The value doesn't really matter because that should come from your data. But what this does is now you are going to have a mechanical confirmation because this is not going to change, right? This is not going to be dependent on your time frame. The only thing it is going to be dependent is the range. And because it is a percentage, it doesn't matter if a range is on the 4 hour or 15-minute or whatever. That's irrelevant because it's a percentage. And because it is mechanical, now every trading confirmation that you get is going to be more or less the same. So this is basically acting as minimum, right? Because price can obviously give you a large one, which is fine because that is going to be even more confirmation. So what you're going to get here is you're going to have rules for the minimum amount of confirmation which you're going to get, right? Okay, so we've done with ranges. This is everything we have regarding ranges. And the next topic would be liquidity, and that is, you'll get that next weekend. And yeah, if you have any questions, you can subscribe to the Telegram and you'll be able to contact me via Telegram. So see you next week.